Welcome to the Chevalier View. This is where we move beyond weekly headlines and focus on structural themes shaping portfolios. Rather than reacting to short-term market volatility, this series is about perspective, discipline, and understanding how history can inform long-term investment decisions. One theme that has resurfaced recently is the risk of oil supply shocks driven by geopolitical events. These moments often create abrupt volatility in energy prices and a renewed concern around inflation and market stability. On the chart that we're looking at today, we're examining how the S&P 500 has historically performed following geopolitical related oil supply disruptions going back to 1990. Now, this analysis includes such events as the First and Second Gulf Wars, the Arab Spring, disruptions in the Niger Delta, tensions around the Strait of Hormuz, attacks on Saudi oil infrastructure, and the Russian invasion of Ukraine. In the very short term, market reactions tend to be muted or slightly negative. On average, the S&P 500 was down about 0.4% 2 days after these events, and down roughly 1% after 2 weeks. In other words, the immediate reaction tends to be uncertainty rather than panic. As we move out to a 2-month time frame, the market picture begins to stabilize. On average, the S&P 500 was already modestly positive, up about 1.5%. But the most important part of this chart comes when we extend that timeline. Historically, 1 year after an oil supply shock, the S&P 500 has averaged a gain of approximately 12%. 2 years later, that average return rises more than 32%. Now, while individual outcomes may vary, the long-term pattern is clear. Markets have shown resilience following energy-driven geopolitical disruptions. The takeaway here isn't that volatility should be ignored, it's that volatility should be contextualized. Energy price shocks often grab attention in the moment, but they have not historically altered the long-term return trajectory for a diversified equity portfolio. At Chevalier Wealth, this reinforces the importance of discipline and structure during these periods. Our partners and we implement model portfolio strategies designed to deliver institutional-level diversification, risk management, and consistency. This approach is intended to help investors remain positioned for recovery rather than reacting emotionally during periods of uncertainty. The Chevalier view on oil supply shocks is straightforward. History favors patience, discipline, and staying aligned with a long-term plan, especially when the headlines feel uncomfortable. As always, our focus remains on maintaining discipline through changing market environments. Short-term headlines, whether geopolitical or inflation-related, can create noise. But lasting progress comes from staying committed to a strategy built around your goals, your risk tolerance, and your broader financial picture. Stay disciplined, stay informed, and we'll talk again soon.